Hey everybody, welcome back to the channel. My name is Zach, and today we're going to go over the big question of the week, which is, are we in a recession? And my personal opinion is that we are not in a recession, not just yet at least. I think that there are a few things that we need to look at before we can determine whether we are in a recession. There's also just not any real confirmation. I think a lot of what we've been seeing happening in the market has been just a lot of fear and uncertainty. The market has been getting all-time highs for the last several months, years even. And on top of that, we have some signals that are starting to tell us that we are going to be approaching a recession. So I don't believe that we are currently in a recession, but I do believe that we are going to have a recession. I do not know what that looks like, and I do not know when, but with the tools I'm going to give you, we can all kind of understand what that might look like and when that might happen, with at least a rough estimate. I would think that politically, we're not going to see a recession until after the elections here in the US. And you might be wondering to yourself, well, Zach, what can I do? What am I supposed to be doing? Is it just the end of the world? And no, it's not the end of the world, but I think that there's a lot of opportunity. A lot of people out there like to really capitalize on people's fear on this topic, where I really do think that there is a lot to be gained. For the last 15 years of at least my adult life, I have not seen a financial crisis or a recession. The last thing that I remember was when I was in 8th grade in 2008, when the housing market crashed, and I was just too young to fully comprehend what was happening. So the fact that there hasn't been any recession or financial crisis really since then kind of, to me, raises a red flag on, one, we were a little overdue, and for two, no one really knows what's going to happen and no one's fully prepared for this. So I do think that there's a way to capitalize on it, and we'll be going over that right now. Now, our options when it comes to a recession are slightly limited, only because if you're already in the market and you've been doing short-term trading for less than a year and you want to try and pull out the gains that you have made, you may be getting taxed 22 to 30% depending on what your income is, and it'll get taxed onto your tax bracket. So, if a recession brings the market down 30% and you take a tax hit for 22 to 30%, then you're really not going to be saving yourself any time, money, or headache. So if you're already in the market, there's really only one thing to do, which is set some money aside that you can put outside of the market so that when the market does go down, you can buy back into the market. Now, if you have long-term stocks in the market, then it may or may not be worth taking your money out, only because of the capital gains tax, depending on how much you did profit over the holding those funds for over 1 year. So a long-term account would be something that you've held the stocks for more than 1 year. Then you might only get hit with a 0%, 15%, or 20% capital gains tax, which may be more feasible. Maybe you would want to take some of that money out, but even then, historically, holding your money in the market is usually a better bet. It's just that, yes, you could have made more money if you had sold out or found extra cash. Now, one of the big pieces of advice that I would probably give above anything is to make sure that you have cash on hand. And what I mean by this is to just have cash on hand. The cash is king motto, or the cash is king reference, which a lot of people, if you know me, then you will say that reference to me a lot, which I find ironic because my last name, but cash is king in the scenario of a recession. So what I mean by that is, imagine, if you may, you're at the mall and it's right before Christmas Day and you're paying an arm and a leg to be getting that PlayStation or the clothing or that's, the Christmas socks that are marked up at $40 because they're Christmas socks. Now you pay all this money for those gifts. Now you got 6 months down the road, that same mall that was selling you all of that at Christmas time is now marked down at a closing sale because the mall didn't do very well during its past earnings, and now it's all 70% off on the closing sale. So you have a mall where you were paying premium, and then 6 months later you have the same mall at 70%. Now your dollar, when the mall was at all-time prices, wasn't really worth a whole lot. It was worth maybe this much. But if everything is reduced in price, then your dollar is actually worth a lot more. So your dollar is here now, while everything is off at 70% off in the mall. And the mall in this scenario is the stock market. So having cash in your hand is actually going to be more valuable than some of the other assets that there are. Not to say that gold or silver or crypto are bad investments or even real estate, but I do believe that everything is stacked high. We got crypto, we've got real estate, we've got the stock market, and we even have gold at some of the almost the highest they've ever been. And you have the dollar that's worth about this, but if all of these come down, then the dollar will actually be worth more than any of those combined. So having cash in your hands is the best thing you do. So don't make any irresponsible purchases like buying a car that you don't need. Don't be going on any trips that you really can't afford and putting anything on credit, because credit will destroy, or credit cards will destroy, any type of return that you could make if you just had some of that cash to put into the market. So those are some of the things that you can do to profit or take advantage of a recession. So what we're going to do now, though, is we're going to go over the yield curve, which is the 10-year and the 2-year bonds. We're going to go over the Sahm Rule, which is the unemployment rate, essentially, and then we're going to go over the interest rates with the Fed funds. And so we're going to take a look at that right now. So we're going to start with the 10-year, 2-year yield curve inversion, and I'm going to try and simplify this in the best way that I can, because it is a very confusing topic, or it is a very confusing one. And I brought up this chart here that I've got in front of me because I really like this chart. This is the Federal St. Louis Fed.org. I will leave a link in the description for anyone that wants to look at this chart. So essentially, I'm not going to try and get too crazy into the numbers. It is revolving around the bonds and how if the 10-year is subtracted from the 2-year bonds as far as the interest rate, then they equal a certain number, and this is the number. So, this chart essentially just summarizes this, and we are at a negative 0.09, just in case anyone wants that for reference. So the reason why this is important, because this is one of the more talked about signals for a recession, and it hasn't happened yet. So, but this is one of the reasons why I believe that we're going to go into a recession, but we are not currently in a recession. So essentially, anytime that the 2-year bond is worth more than the 10-year bond, it goes into a negative category. And what I mean by that is that you gain more interest from a 2-year bond than a 10-year, which shouldn't happen in my opinion. It makes sense, right? You shouldn't be able to gain more money from having something for a shorter amount of time versus a longer amount of time. So this causes a lot of disruption in the economy, and it has since the 1980s and probably even sooner. But anytime the 2-year bond is worth more than the 10-year bond, and it stays there, this gray bar here on the chart indicates a recession. So we were in 1979 below it for about a year or two, and then as soon as we hit the recession, the 10-year bond skyrocketed up more than the 2-year bond. And you'll notice that this trend happens for every one of them. Anytime that there's the 2-year bond worth more than the 10-year bond, this line goes below the black line, and as soon as we hit a recession or we're close to one, the 10-year magically just becomes more than the 2-year again. And you'll notice this trend all the way down. So as long as it stays above it, we're fine. As soon as it goes into the 2-year being worth more than the 10-year, no matter what circumstance, a year or two later, there is a recession, and then the 10-year is magically worth more than the 2-year again. And same thing here. It tapped it in, this is the 2000 dot-com bubble, and it happened in 1998. It tapped it, we stayed above it for a while, but then you fell below it, and magically the 10-year bond went up in rates, or it went up in value, but the recession still came. Same thing in 2006 and 2006 again. We were tapped below here, the interest rates went up, and recession. COVID, I guess you can count this as a recession. We tapped it at a zero. They broke even, so the 2-year and 10-year were worth the same amount, and we went into the tiniest little baby recession ever, even though there was a long period of time of suffering. But they gave us free money, right? And they gave us 0% interest and 0% down. Well, unfortunately, you have to pay for that eventually, and it wasn't now, or it wasn't then, but it is now. And so, we were good for a while, then we plummeted down, and we have been pinned down below. The 2-year bond has been worth more than the 10-year bond for a while, and not just for a while, but by more than any of these other circumstances besides in the 80s. So the 2-year bond has been worth more than the 10-year bond for 2 years and going. And I think that this is going to have a significant impact on when this recession happens and what we need to look for. So essentially, as soon as the 2-year bond is worth less, or the 10-year bond starts to become more than the 2-year bond, that is a huge indicator of something happening, and we might want to be buckling up. So this is chart number 1, the 10-year, 2-year yield curve. Like I said, I'll have a link in the description below to look at this. Now, the second one is the Sahm Rule, which I've recently actually just discovered this one, but it does make a little bit of sense. It is accurate. Essentially, this is the rate of which unemployment goes up. So essentially, it takes an average of the last year, and it takes that average, and if it starts to go up too fast, then it usually signals a recession. Now, the funny thing about this one is that each gray line here, yes, once again, is a recession. But as you can see, if you look at this, is that so the rule is that it's a 0.5. Down here, you can't see it too much, but it says 0.5%. So anything at 0.5% means that we're in a recession. So 0.53, we're already in the recession in 1960. As right here, looks like 0.53 again in 1970, we were already in the recession. Same thing here. We were already in a recession well before that, and we got to 0.5 around July of 1974. We were already in the middle of the recession. We were at 0.67 or 0.5 during the 1980 recession. Same thing with the 1981 recession. We were already in the recessions when all of these hit 0.5. So 0.5 middle of 1990. We were in the recession there. Same thing here, 0.53 in 2001. So as you notice here, 0.5 in the beginning of the recession in 2008. And then I guess there was one here too, but it's hard to kind of see where that is. So we're already at, the big concern here is on the far right here, you can see we're already at 0.5%, and we're not in a recession, apparently. And I don't think that it means we're in one, but I do think that it is screaming the fact that we're going to be going into one. And I think the elections and a lot of other factors are kind of contributing to us not being in one just yet. But we are going to be in one, in my opinion. And it's not even a question. It's just going to happen, and I don't want it. But I do think that if you're prepared for it, you are going to be okay. If you're not prepared for it, I am sorry. It is very sad. In the movie The Big Short, one of my favorite movies, it says that for every % that the unemployment rate goes up, about 40, probably nowadays 50,000 people pass away. That sucks. So this essentially is saying, we're at a rate of unemployment going up faster than average, and it usually indicates a recession. So this is chart number 2, the Sahm Rule. I'll also have a link in the description of this chart below. Now, the last one I want to look at is the Fed funds rate, which essentially is just the interest rate that the Federal Reserve sets. And you'll notice another interesting trend here. Each gray bar here indicates a recession, each one of these gray bars. And if you notice, in front of each one of these gray bars, we're at a relatively high interest rate. So higher interest rate, and then recession, they cut the interest rate. High interest rate, recession, cut the interest rate. Same thing over here, 1970 or 69, high interest rate, recession, cut the interest rate. Same thing as long as this one, we had 1973, high interest rate, cut the interest rate, and then recession, then they went up again, and then really had to cut the rate. So essentially the rate is that, it's what you get a loan for. So you get a cheaper rate for maybe a house or a personal loan. Instead of paying 10% on a loan, you're going to pay 5 or 4%, which we've had for a very long time, but then that recently went away because everyone was buying everything. So, same thing here, high rate, 1980, then, cut the rate, recession. Or during it, they cut the rate. Same thing here, high rate, cut the rate, recession. High rate, cut the rate, recession, high rate, cut the rate, recession, high rate, cut the rate, recession. And so, repetitive, but we're at a high rate now. And we haven't been this high since 2008 or 2007. If anything, we're actually above it. So, and then same thing with the .com. We're not even, as high as the .com, but when everything's extremely expensive, a high interest rate or even of this high is extremely expensive for people, so they can't afford it. So with all 3 of these charts, we've got some clear indications that we are going to be going into a recession. It's not really a question in my opinion, it's just a matter of when. And so if you have any questions, comments, or concerns about what I'm saying, I do think that there is a lot of positive that can come out of this. It does not have to be all doom and gloom. I think that there's a way to be prepared. That's why I'm making this video. And so, there's a lot that we can take advantage of as long as you don't make any, purchases that you can't afford right now, and you do have cash in your hands. There is a light, because at the end of the day, I want to follow this up with, no matter what recession we've had, whether it was the .com or whether it was 2008, as you can see here, or if it was COVID, we have always came back. We've always come out of it with gains. So the only thing that you can really look at this at is, like I said earlier, is the discount store. You're at a mall when the recession happens. If you've got some cash, throw it at the mall. Buy some things you've always wanted. If you want that Apple, you want that iPhone, buy the Apple stock. And who knows, maybe the profits you gain will pay for your iPhone. Same thing with those fresh Nikes that you're looking for. Maybe if you want to get those Nikes, you just own Nike themselves, and then Nike will pay for your shoes. So you got to look at investing like in a way where if you trust buying a product, why not own it? So I say all this to say that I think that we're going to be okay. I think that if you're watching this video, I appreciate it, and I think that it's going to have a lot of good information. So I appreciate you sticking around, and remember to hit that like and subscribe button, and I will see you in the next video. Thanks.